a range of subject matter specialists. So I'd like to welcome you to Rounded Wealth Advisory's annual webinar. I myself is Finlay Lafleur, founder of Rounded Wealth Advisory, inspired for ensuring delivery of quality and compliant financial advice to Australians, individuals and organisations as cost-effective and efficient as possible. We are licensed directly with the regulator, ASIC, as you may know it, and as such, we are required to meet heightened standards for regulatory and industry compliance. This ensures we are aligned with our clients' best interests at all times. And as part of acknowledgement, I acknowledge the traditional owners of the land on which we are meeting. I pay my respects to their elders, past and present, and the Aboriginal elders of other communities who may be here today. And as such, I guess introducing the range of subject matter specialists that will be joining us today and panelists as such. That includes Charles Blake from Your Exponential. He's the financial services consultant that provides a range of solutions to different financial planning firms. Charles has been instrumental with helping Rounded Wealth with various things about efficiency and implementing technology. So we'll deliver some of our aspirations, which is cost-effective advice. So I'll get you to have a quick chat, Charles. Also joining us is Evelyn Albrecht, who's a long-term compliance consultant. She is most helpful with ensuring that we meet the regulatory requirements. As many changes that have occurred over the last 2 or 3 years that impacts us as a financial license amongst all our peers, it's about making sure we're at the forefront of standards. Colin Lee from Inspire Realty is also here. You may or may not know Colin Lee. I'll be very surprised if you don't know him. He's our media darling at the moment in terms of all things investment property management. He's at the forefront of helping clients manage their portfolios, that he's got an unquenchable hunger for helping people to advance their wealth. Also joining us later on will be Sam Weiner from Australian Super and Frank Danielli from MA Group, just to give us their perspectives and insights on various other things that are, I guess, shaping their team's views on how to position their portfolios, both in a whole, in a diversified perspective from Australian Super, but also in a various sector segments perspective in terms of what we call private credits, which is a bit of a phenomenon that people, I guess most even advisors, sort of very briefly understand. And just by way of presentation, I guess just to introduce who Rounded Wealth is, if you have dealt with us for a while now and know a little bit about us, we're actually a small financial advisory firm. As I said, we were licensed about 3 years ago as a continuation of myself as being an advisor, providing an opportunity and a safe, compliant home for our existing clients to continue to be serviced. Our endeavours has always been about the client first, their goals and objectives at the paramount and forefront of what we do, and the rest are solutions. And definitely the product that follows that is a function of understanding their goals and objectives. We don't manufacture or produce any products. And as a result of that, we seem to want to provide quality, compliant and cost-effective financial advice with everything we do. As conflict-free as possible, we deliver a bit of a hybrid face-to-face and digital advice model, make it easier for most of our clients to access us. Believe it or not, where it used to be a face-to-face business, and we still love that part of what we do. Oddly enough, with the advent and acceleration of COVID pushing most digitally, a lot of our clients existing say, we love seeing you, we love meeting you, but we can get on with this sort of Zoom and virtual conferencing, and we prefer that than having to brave the traffic and having fines along the way and finding parking and having sweaty palms. It's just not us anymore. And I said, I'm not that bad, am I? Hopefully I don't give you sweaty palms, but they prefer that kind of mode. So we provide a range of flexibility on how we see people. As we said, clients needs first. And for us, the fee for service approach removes us from completely from our inception, from the whole idea of conflicted revenue and conflicted remuneration. We don't take any commission from products. We actually pretty much charge for the advice that we provide our clients. So that removes that conflicting nature of it. We're not institutionally driven. So in other words, we have no legacies. For us, that just means being present with clients. If it means an hour, 2 hours, 3 hours to understand their goals and objectives, to get the solution and the strategy right, then so be it. And also, our whole being is to be lean, mean, and green. For us, that's about what we started to be and what we'll continue to be. And from that perspective, it's worth acknowledging, as I've said, that the three individuals along the way that's helped us set up and establish a compliant framework within which we're proud of, and will continue to hold that standard. And most advisors or partners that potentially join us in the future that can also adhere to that standard. So starting here, Nguyen, who's our operations manager, and from the get-go, there were a whole range of compliance requirements that we had to meet and adhere to for the regulator. She has an extensive experience in accounting and auditing. So I'm highly thankful to her for us continuing now almost 3 years on. Charles Blake, without this guy, there's no Rounded Wealth Advisory. And I remember sitting down with him at a coffee shop talking about setting up my own license, and I think he said, "Yeah, that sounds about right. You'll be good about that." But I'm sure in the back of his mind, I was thinking, "You crazy bugger," with the fallout with the banks and all other major financial planning firms at the time. But it's been the best move forward. Charles been instrumental with, as I said, establishing a lot of things from the get-go, and definitely why we've continued to exist. And his experience in technology and efficiencies due to his experience across a whole range of planning firms have been priceless, I guess. And Evelyn Albrecht, last 2 or 3 years, last 2 years particularly, she has become our set of eyes, our line of defense, in that she basically provides the standard as per the ASIC requirements and ensuring that we adhere to that. But there's a compliance lens with which Evelyn applies to most of her interactions with us, that yes, we have to be highly compliant, but there's a commerciality with what we do, and what is the balance between that. So she's fantastic in that regard. So in terms of acknowledging the 3 people, thank you. I understand one of them is still waiting in the queue, so I'll try to sort of get her in. And just bear with me for a second while I zoom through that. Yep, seeing what I can do. Okay. And continuing on, I guess, making sure we sort of, most of you that have been through the financial planning services with us, that you have an idea of what we actually let's have a look. Can you see that screen there? Yep. So financial planning services for us is a whole range of things other than financials. We look at really the 3 sort of buckets of requirements and needs from our clients. So that's wealth accumulation, wealth protection, and wealth distribution. And overlaying that is a whole range of personal requirements, more than just financials. And we help our clients manage their cash flow budgets, their superannuation, retirement needs, debt management, and various other needs, including wealth protection and wealth distributions. We believe that just focusing on wealth accumulation is one part of the advice, but we also need to make sure we safeguard our clients from the unknown or the unforeseen circumstance. And the value is in the eyes of the beholder, but we make no apologies in ensuring that whatever we charge on a fee-for-service business it's marginalized compared to the value that's derived from it, and that includes the personal peace of mind and the clarity of the future. And for us, that's the value that we want most of individuals and organizations that go through the discovery exercise with us obtain. Whether they do engage us or not, we still try to be a voice of counsel for them, and that's all good well in terms of our being. And I really enjoy this quote. For us, it's not about changing the world as an advice group. It's about small steps to make a difference in our clients' and partners' lives. And it's one more step for man, one giant leap for mankind. And so every household or every individual we help meet their goals and objectives, it means a better financial well-being, and technically means a better overall well-being. And that's truly what we're about as a whole. And our guest speakers today include Sam Weiner from Australian Super, and also Frank Danieli, who will join us about 3:30, and Colin Lee, as you've got there, the founder and CEO of Inspire Realty. So without further ado, Charles, you may want to kick off in terms of technology and various things that you see in financial planning services and important to advice to Australians moving forward.
Yeah, look, I'd love to. And I think, given you've got a few speakers on the list here, I might keep it pretty short and punchy rather than launch into a big presentation or anything like that. But look, I think just to sum, did you mean to stop the...
Sorry.
No, you're right.
Allowing you to share.
I just got the recording stop progress, that's fine. But look, just to make a few quick comments and things that we're seeing. So for the audience, yeah, it's been fantastic to work with Finlay and Hien and even Evelyn on what they've achieved with Rounded Wealth. It's just so interesting to see a journey and a business evolve. So you should be very proud of what you've achieved, and I'm excited about the future. For me, in addition to Rounded Wealth, I work with advice firms all around Australia to help them become more productive, to embrace technology and use it in a smarter way as possible. But I think the key question that always comes in is this going to translate to a better experience for our clients? And so that's something that Rounded Wealth live and breathe, and that kind of technology is really exciting now. So in Rounded Wealth, they use a CRM called Advisor Logic, and it has a portal which just makes it easier to be able to converse or share information. And those sorts of things are going to be more available, which just make everyone's lives easier. With any new technology or system, we know it can be either a bit weird or scary the first time we use it. But for these things, any time Rounded Wealth is going to bring a innovation to light, it's going to have been tested, and something like that certainly has. So, you know, well done on running an efficient business from behind the scenes. But I think the key to all clients in the audience is if you've got ideas and things that are going to make your life easier, put them forward the next time you have a chat with Finlay, and you know, as you know, he'll be all ears. It's just it's a healthy feedback process. I guess in the marketplace too, there's been a lot of interest in ChatGPT, and it's a generative AI, and people are thinking, what's all this about? And I actually have looked at it and used it a lot. And what's so key with something like that, where a technology comes about and everyone gets really excited, and it was the first solution to get 100 million users in a few months, but even from having a good look at that, it doesn't take away from the need for quality advice from someone who knows your specific situation. And any generative AI or anything like that, it won't replace financial advisors and the quality work that Finlay and Rounded Wealth do. So it's worth a bit of a look. It's a free solution and everything, and it can be a useful tool. Its grammar and everything is flawless. That's why they banned it in schools and universities. But you know, we keep an eye on these sorts of technologies. It might make a useful thing in explaining some things in the background, but certainly, you know, it's just about, for clients, making your lives easier to be able to share information, but also to be able to do that easily and securely. And yeah, the last point I'd probably mention, Finlay, is the sort of work that is done behind the scenes on security, like cybersecurity. You know, quite a few companies like Toll and Optus have copped it, and they've had very serious issues. Even for a business, a small advice firm, quality small advice firm like Rounded Wealth, they take your data very, very seriously in terms of its security, and all of the sort of rigor they do behind the scenes means that it stays secure. So funnily enough, just like when we went from checks to online banking in the 90s, we got very used to email, but email is not necessarily the most secure way to communicate and share information. And that's why things like that portal that we mentioned, those will come into play, because you can have, you access it through a second authentication. So yeah, it was just, it's been, you know, great to get, I think you've done an amazing job on setting up your platform. For clients, please put forward your thoughts and ideas of how things would be easier for you. Mentioned of, if it's a hybrid meeting, how can that come to life, and you have the best sorts of conversations and reviews that you want to need, and the technology plays a really key part. So yeah, those sorts of the main points, Finlay. I thought would make it nice and brief to allow full time for the guest speakers.
Oh, wonderful, Charles. And with that in mind, do appreciate the good words, and I think, as we said, your support over the last few years have been instrumental to getting it right and making sure that clients have a safe home to be serviced. And data integrity is something that we are very strong about, and privacy, and not just a regulatory requirement, a tick and flick exercise. So thanks, Charles, for that. And Evelyn, if you're up, if you're around, hopefully you're there somewhere.
I certainly am. Thank you.
Yes, welcoming you again. And I guess from your perspective, you look after a host of advisors in your network, and there's a whole range of work and changes in regulatory landscape. I mean, the amount of changes we've had towards financial planning in the last 12 months, let alone the last 3 years, have been next to unparalleled and unprecedented. I try to think how you keep up with it all, but I'm just glad that you provided a nice little bundle for us to know this applies, this doesn't apply, and how do we make it work. Over to you.
Thank you, Finlay. Yes, so I've been working with Finlay and Rounded Wealth for the last couple of years, and my role is as a compliance consultant to the business. And as Finlay rightly said, there's a whole number of laws, rules, regulations, and other bits and pieces that financial advisors and licensees have to adhere to. And part of the reason for all these rules is where things have gone wrong. Now, I'm sure all of you remember the Hayne Royal Commission, which seems like it was forever ago, but it's only really 4.5 years. So it is still reasonably fresh, but we've had a lot happen since then. But there were other reviews prior to that, and misconduct, and so a lot of rules were put in place with a main aim to protect consumers and to make sure that they get advice that is fit for purpose, or as the law says, meets a best interest duty, so that the advice they provide is in the client's best interest. That doesn't mean necessarily that they will always be recommending the fund that performs best, because we don't have a looking glass to look into the future, and financial advisors are no different when it comes to that. But what it means is the steps that are taken to assess what clients need and how the advice that they are given meets their needs to achieve the outcomes they want as much as possible. Obviously, in some cases, one might not be able to achieve everything the client would love to, but then it's about finding the balance and going through what's important to the client. And that's where, from a client's point of view, and we're working with Rounded Wealth, it's about those steps and making sure that when a client comes to Rounded Wealth, they get the service they are looking for. At the same time, the documentation that is being prepared meets the requirement. And when preparing for this, Finlay sort of said, oh, can you talk to the importance of compliance and file management? Firstly, compliance is all about meeting the rules and regulations, but also meeting the client's needs. And that's really the forefront. And that's my role with Rounded Wealth, is to assist them in meeting the rules, and then also assisting them in how they can meet the requirements of clients while following the rules. And given a number of changes in recent years, that has been a little bit of a challenge. But what's this resulted in is there's a whole series of documents that are provided to clients as part of the financial planning process. It is a sort of a fact-find document, risk profiling questions to understand investment risk and the approach a client might have. And it is really important for clients to participate in that, because that assists Finlay and any financial advisor in being able to provide you with recommendations that meet your needs. And it's also important that then the documents they provide, they are intended to give you the full information so you can make an informed choice. So it is important to keep those documents and ask questions. And I love to see, when I do a file review, if emails go back and forward. And for me, from a file review point of view, I just look at it, has Finlay and Rounded Wealth considered the client situation, and does the recommendation sort of meet the requirements? And I like to see that interaction and the engagement, and that really makes it a great relationship and does facilitate Finlay being able to provide that advice. And that's what Rounded Wealth, based on my experience in the last 2 years, is about. It's really helping clients achieve what they would like to achieve from a financial planning point of view. One other question Finlay put to me briefly was, how is Rounded Wealth as a licensee compared to other licensees of a similar size, similar nature? I would say very well. I'm hopeful that clients that work with me really put meeting requirements at the forefront as part of the basics of running a financial planning business. And Rounded Wealth is, taking this proactive step to hire me in terms of someone else that has expertise that they are not necessarily dealing with on a day-to-day basis. Exactly like a client goes to a financial planner to get assistance on financial planning advice, something they don't necessarily deal with on a day-to-day basis. That said, in summary, really Rounded Wealth has done a lot of work in the background to ensure that they, what I'll call it, do the right thing by the client. And that is really at the heart of their service offering, helping the client achieve their outcomes. My assistant hopefully means that Rounded Wealth can provide that in the most efficient way from a compliance point of view. There are others that help with IT and with other things. That's not my expertise. But from a client point of view, what I'd always suggest and recommend is really to, and also from any provider, work with us. Compliance sometimes is seen as a bit of a negative. I'd like to turn it around into a positive, in that if we help you achieve your business needs while meeting requirements, then that provides the perfect solution.
Oh, fantastic, Evelyn. That does give most attending here online or offline a good idea of the requirements that we adhere to, and also your assistance there in helping us meet those requirements, and keeping everyone safe and sound whilst under our advice and counsel. Thank you, Evelyn.
No worries.
Next speaker, we've just brought into the front of the queue, is Colin Lee from Inspire Realty. Hope you're around, buddy. Welcome. Just by way of introduction, Colin is the founder and CEO of Inspire Realty. His passion and purpose is to empower his clients to achieve financial well-being and create wealth through smart and strategic, profitable property investments. Colin is a trusted property advisor and a thought leader in the property space, and helps his clients map and model out their inspired future. He started out as a maths tutor all those years ago, which I've crossed road and was introduced to Colin, and a waiter with $25,000 in savings, and turned it into a $5 million property portfolio, generating him over around $150,000 a year in income, as in passive income, which we talk to our clients about all the time. He started Inspire Realty, which is his business, with a vision of inspiring his clients to take charge of their finances to ultimately live a better future. Colin has recently been featured on Channel 7, news.com.au, Daily Telegraph, ABC, Financial Review, Courier Mail, and most recently, Koshi's Business Builders. Without further ado, welcome our celebrity guest speaker, Colin Lee.
Thank you, Finlay. Thanks for putting me up. But just wanted to thank you as well for the opportunity to be able to share my story. And what I would love to be able to run through with you all today is a bit of a property market update. But before I do that, obviously, there's a few things I'd like to be able to touch on, just to be able to help you to understand the motivation or the inspiration behind why I do what I do, which is quite exciting. So I'll give you some quick tips on, what to look for in the property market. Obviously the interest rates have all been increasing, and obviously that's had an impact in the property market. But in any markets that we invest in, there's always obviously opportunities. In the last 13 years, when I started investing, I've bought properties, probably one property every couple of years. So you can see that, there's a lot of events that's happened in the last 13 years, but yet I've still been in the market, quite consistently, because whether the market is up or the market is down, whether the interest rates is up or down, there is always opportunities, and it's up to you to spot those opportunities to get them across the line. What I'm not going to do is I'm not going to be trying to time the market and buy at the bottom of the market, because I think that's, genuinely a futile exercise. I'll never get it right. And if I did get it right, I won't be standing in front of you and presenting to you. I'll probably be out in Bahamas or Maldives or doing something different. But the reality is, I'm building my wealth in a safe way, in a structured way, in a very systematic way, because I'd like, my risk profiles is quite low, so I'd like to do it methodically. So I could never guess the timing of the market. What I am going to be talking about is time in the market, and I'll show you some key statistics in terms of what's happened in the market. Certainly Australia, as long as time could have measured that. So what I'd like to do, Finlay, if it's okay with you, I'd love to be able to share my screen, because I've got a little bit going on, and share with you some good news and what's been happening in the market.
Fantastic.
Can you
see that?
my
I hope
screen?
Everyone can.
Yeah. Now I've put a picture of the, I don't know if you guys can guess, but for those that know mountains, that's Mount Everest. And I love that mountain because I feel like our lives is about climbing mountains, and we're all trying to hit somewhere. We're trying to hit the, or reach the top of the mountain in some way, shape or form. And it's good to have experts or financial experts, people like Finlay, along the journey, because it's not an easy journey to climb up the mountain. You'll need some good help, some good people along the way to help you get there. So before I get started, I just want to share with some good news with all of you. Recently, I went to a Westpac Economics Forum, and they did this massive presentation. There's probably about 50 slides, but I'm only going to pick 2 of those slides to be able to share with you. because it's something that everyone's talking about now. As we know, the inflation rates is going up. It's going through the roof at the moment. But the other good news is that inflation, as being recorded by Westpac at the moment, a lot of sources are pointing that the reading of the inflation rate has reached its peak. So however you want to read that, but I think it's only a matter of time before the interest rates will come back down, will pare back down. It may have a couple of rates rising up again before that happens. So I have taken a very optimistic view in terms of what's happening in the property market, because when I invest, I always look at the long-term strategy. But there's something else happening, and this is an article that I've taken out of the Financial Review, and this is something that I'm noticing every single week, because between my team and I, we look at hundreds of properties every single week for our clients. We're essentially a buyer's agency in a property advisory business. So a lot of clients come to us, they're busy professionals like Matt. They want to focus on building their business and doing what they're really good at, whereas we do what we're really good at, which is source properties, and we negotiate on behalf of our clients and we get the deals across the line. So we're on the ground. We're literally like our eyes and our feet and our hands for our clients, and we're going out there and seeing properties. But something is happening. Something crazy is happening. A lot of people are cashed up. I think this is post-COVID, and even up till now, people are actually cashed up, which is why I don't see the market really responding terribly towards the rise in interest rates. There are certainly a proportion of the population that's going to be very heavily impacted by the interest rates rises, but really it's only a percentage of people that will be affected. So, but the reality is, and I'll talk about this a little bit later on, the reality is that in Australia, we do not have enough properties to be able to address the demand that's happening around. And that's across the board of all Australia. And the reality is this, like if you look at this is data that was compiled by the Digital Finance Analytics. It's showing that people that get pre-approvals, these are people that have gone through the whole documentation process with a mortgage broker. And then the mortgage broker says, yep, here is a letter. The banks are happy to lend you $2 million, go out and go for your life. 40% of properties at the moment that have got pre-approvals cannot be committed to a mortgage because they just couldn't find the properties. So that's a 40% attrition rate. And a part of that, a sizable chunk of that, which is 14.81%, nearly 15% of them is due to lack of stock. That's never before seen because it is such low supply at the moment. It's really affecting the entire property market in terms of supply. So, in the past, I used to be able to go to 5 or 6 listings in a day. Now I'll be lucky to pick and do 3 or 4 listings in a day. So it's really, really interesting to see the lack of supply in the market. But before I go a lot deeper, there is a personal side to myself, and I'd love to be able to share my story about why I do what I do. And I hope that helps you to understand my internal motivation and why I love to be able to, share my story, but also inspire a generation of property investors to start taking charge of their financial future. Just very quickly, I'm married. That's my wife. She's a project architect, so she looks after our entire property portfolio. I know Finlay says we've got a $5 million property portfolio. That's just our investment properties. And my wife is a project architect, so she looks after a lot of that. She adds a lot of value to our properties, essentially manufacturing values in our properties to help it increase in equity, but also in yield. I've got a 3-year-old daughter. In fact, she's home today. So if you hear screaming around, that's because she had a nosebleed and we had to take her home. But my story started out, as Finlay was saying, I've been featured in a number of media articles, but I really started, very humble beginnings. I had $25,000, which I saved up for 9 months working as a tutor, a waiter, and actually an intern electrical engineer. And over the last 13 years, I've consistently built my property portfolio, and with the view that I'd like to be able to retire when I'm 50. I'm 42 this year. So I'm well on track in my retirement. I've used property obviously as a vehicle towards achieving my financial freedom. So for me, I'm biased on property, but that's also because I'm a buyer's advisor. Now, one of the things I'm really proud of, because one of my major motivations is to inspire a generation of property investors to take charge of their financial future. It's really good to be able to see in the last 3.5 years of running this business, my voice has been heard. And most recently, I've been heard on 7 National News. I've been on Sunrise. That was quite nerve-wracking, but just in January this year, I've been featured on Koshi's Business Builders and amongst many, many, many different media channels as well. But I don't do this on my own. I do this with a team of people, of advisors, of property advisors, but also buyers agents and researchers. I've got a team of 5 people that I work with, so 6 altogether with us. And one of the things we started out when we started Inspire is we realized that for us, what's really important is we make an impact in the community and in society. So I just want to share with you very quickly, just to touch on some of the organizations, the charities, the communities, and the causes that we support. I'm supporting the Aboriginal community at the moment in being able to facilitate their literacy program. So that's what I'm funding as a business. See, I believe I've made enough money, and now I'm really going out there to support other people. And that's what I inspire my clients to do. You know, we do more for others than sometimes we do for ourselves. So find a cause, find something that you can, you know, help out and contribute to. I was part of the CEO Data Cure for the Children Cancer Institute most recently. We raised about $521,000. I support the Sebastian Foundation. For those of you that don't know, this is obviously run by Sebastian Foundation, and they run a housing program for domestic violence communities. It's a really wonderful organization to be part of. I'm also and was the president of the Australian Malaysian Singaporean Association, so very much part of my local community. I'm also part of Mentoring Men, and together we raised $40,000 a couple of years ago. I personally use Mentoring Men as a service. It's the only free one-on-one Mentoring Men service for Australia. 3 out of 5 suicides come from men, and so it's really good to be able to participate in that. Now, one of my goals as well is to inspire a generation of millennials, but also Gen Zs. They're all emerging people that are eventually going to be coming into the marketplace. Really sad to see that it's going to be harder and harder for a young person to get into the property market. And so that's why I speak at a lot of schools, I speak at a lot of universities, just to be able to help students understand the importance of saving up and preparing for their financial future. And this is the reason why. According to the Australian Treasury Intergenerational Report back in 2010, they released this report and they suggested by 2050, which is well on track, around 1 in 4 Australians will be over the age of 65. And financial planners will tell you that's when you can start to tap into your super and your pension rates. But based on the current recent predictions, they've increased it from 36 million to 40 million. But it is predicted in the next 30 years that Australia will increase its population to about 40 million. So 1 in 4 Australian, that means there'll be 10 million of us in Australia that will be over the age of 65. The problem is this, though. The problem is that according to the Human Rights Commission Face the Facts report, I know this is back in 2014, but back then it was 80% of Australians over the age of 65 will rely on the age pension. And get this right, my friends, 1935, 42 people worked for every 1 retiring. You fast forward a few years later, in 2020, 4.2, so 10 times less the number of people that work for every 1 retiring. It is predicted by 2050, 2.7 people will work for every 1 retiring. So for me, being a Gen Y myself, I just think by the time I reach 65, which is only 20-something years away, I don't know, there'll probably be 1 worker, for every 1 retired by the time I retire in 30, 40 years. So there'll be not enough pensions going around. In fact, in 2021, about 195, nearly $200 billion was spent on welfare. What I'm doing is I'm really helping Australians to take charge of the financial future and not have to depend on the government. You know why? Because according to the Australian retirement statistics, 70 to 80% of people will depend on the government for their retirement. 22%, which is a quarter of Australians, will have to continue working because they cannot afford to retire. 7% would retire without working. That's why you need a good financial plan. But 7%, but only 1% of us will be able to retire financially secure. So that's crazy statistics, right? And people say, well, I'll depend on my pension. I'll have superannuation. But as we all know, that's never going to be enough because we are living longer than ever before. According to the World Bank, we are living now to our mid-80s. I think there's some recent stats that females tend to live to a little bit longer, to 85. We live to about 83 as males. So if you just predict that, if you just project that at the age of 65 when you retire and then 85 when you do get on your life expectancy, that's an extra nearly 15 to 20 years of living to do. I'm not going to go into too much of this, but as we know, I prefer to use median super balances. So this is according to the ATO, but as of 2019, people between the age of 60 to 64, particularly for males, they'll come up with about $178,000 in super, whereas for females, you come up with $137,000 in super. So call it 200,000, divide that by 20 years. That's about $10,000 a year that you'd be living on super. That's frankly not enough, because according to the Australian Super Funds Association, a couple need about $60,000 to retire fairly comfortably, whereas for a single, they need about $43,000 to retire comfortably. So what do we do? What do we do? What can we invest our money in? And once again, I'm a bit biased, but what I want to show you is a house price growth rates over the last 3 decades. So obviously this is some recent data, and as you can see, Sydney, Melbourne, Brisbane, Hobart, Adelaide, Perth, they're all having a little bit of a market correction at the moment. But if you extrapolate that data over the years, you can safely say that property is a relatively safe investment for most people. It's bricks and mortar. People always would need properties anyway. But something I like to show is this. In the last 40 years since recorded data, you can see that there are a lot of big key events that happens. You know, right now, it's the rise of the interest rates and the rise of inflation, obviously. But no matter what happens, properties in Australia have stood the test of time. If you don't believe me, have a look at this. This chart shows data that dates back to 1970. And at the bottom here, you can see that this is the cash rate, which is that red line. That orange bar represents mortgage interest rates. And what's really interesting, from 1990s, that's the peak of the mortgage rates. I think that's about 17 to 18% mortgage rates. At the peak of that, when the recession rate goes down, obviously that property prices continue to go up. So whether it's trending up or trending down, properties seem to defy all odds and continue to trend up in the bigger picture. For a couple of reasons why. Firstly, I just want to share with you that as a migrant myself, we came to Australia as a lucky country, and I know many of my own friends are looking to come to Australia. I tend to have these conversations, you know, every couple of months, and I still get people from Malaysia, where I come from, that say, "Aren't you a lucky man? You're living in Australia. What a beautiful country it is." And it is. And what's happening according to the UN population predictions is that Australia, being the lucky country, is attracting a lot of international applications, visa applications. I've got 3 friends that are visa migration agents, and they all tell me the same story. Watch what's going to happen. Australia is going to have a massive population boom, and we need that because we don't have enough workers. So some deals with Fiji and a few other islands to bring more workers in. But this is the reality. So this article came out in January, and it's predicting that Australia's population will hit 40 million within 30 years. That's a huge amount of increase of people. And the truth and the reality is, I don't get distracted by interest rates and anything else, because I look at supply and demand. The reality is Australia is bringing in about 200,000 people in year on year. Within 5 years, it's 1 million people coming into Australia. And they've just opened up about 30 to 40,000 humanitarian visas that will be coming to Australia. So once again, I look at the data and I'm like, you know what, there's a lot of people coming to Australia. What are we going to do about it? And if that is not enough for you to believe me, have a look at the vacancy rates. This is what professional property investors and economists use. Rates. For those that don't really know about vacancy rates, 3%, which is this particular number here, is what we call a balanced market. When a city, or when Australia is sitting at 3%, it just means supply equals demand. When it's below 3%, obviously the demand is much stronger than the supply. And for the last couple of years, it's been falling sharply. Like Sydney has literally, or Melbourne has literally gone from 4.5%. Obviously that's inflated because people were moving out, but all across Australia, my friends, the vacancy rates dropping through the roof. And I think we're sitting at about 0.84% nationally in terms of the vacancy rates. But the other reason I look at vacancy rates is because then I can tell very, very obviously which market is tight, which city is tight, which suburb is tight. So as a property investment advisor and a buyer's agent, I prefer to buy into areas, because I know that means the rental will just continue to grow. The other thing I look at, and I hope this was useful for you, because I remember when I spoke to a very professional, astute property investor, she had over 25 investment properties. And she says, I asked Wendy, I said, Wendy, what do you look at when you're trying to determine which city, which suburb to buy in? She goes, I look at the interstate migration rates. Where in Australia are the biggest interstate migration? And one of the key states, as we all know, is Queensland. So I'm a little bit biased in Queensland. I have a team in Queensland. I have a team in Adelaide. I have a team in Sydney in terms of finding properties for my clients. But I'm a little bit biased in Queensland. And I think Queensland and Adelaide are certainly emerging markets, because if you look at what's happening in Queensland, nearly 1,000 people are coming into the shores of Queensland every single week. I personally moved to Queensland not long ago, and it's amazing. And I'm seeing people, every person I connect with, where are you from? You're from Sydney, from Melbourne. There's the story of the Olympics as well. So a little bit biased about Queensland. I see that as an emerging market. I see Adelaide to be an emerging market. It's got one of the lowest vacancy rates nationally across the board. So it's a very, very tight market. It's got great industries as well. But I thought I'll show you this because I couldn't believe my eyes when I read this. And if you pluck this article out of Courier Mail, this was put out a couple of months ago, but it's actually saying that sorry, let me just move on to this one. It's actually suggesting that Queensland at the moment, and I couldn't believe it, I had to read this twice, but they're suggesting that median house prices in parts of Southeast Queensland will be among highest levels in the country by 2030. So that's 9 years away, my friends. I'd like for you to ride the wave, exceeding $2 million and beating even Greater Sydney. That is incredible. So I want to ride the wave. I think Queensland. What I want to show you is data. Albeit it's a little bit old, they haven't updated this data yet, but I really like, looking at PropTrack. They normally send this out every quarter, but they haven't done this quarter yet. But back in the last couple of quarters, if you look at the highest growth regions in Australia, it is predicted that Queensland has taken up about 70% of the highest growth regions. Ipswich being the number one, number two, Logan, and number three, Adelaide, which is really interesting. Those are the interesting. Adelaide North is where I buy my properties for my clients. So I saw this happening before it started. I started buying both in Ipswich and Logan. I know some people don't like the Logan City Council, but there's Logan and there's a lot of other suburbs within Logan that have done exceptionally well. Obviously, I like Brisbane City Council, Gold Coast as well, and Brisbane North, which is where I've purchased some properties. But I monitor this very, very carefully, and I look at where is the growth region, where is the emerging in terms of the Australian property market, where it's at. I want you to take it with a pinch of salt, because this is obviously a quarterly report or a monthly report. So obviously this is a little bit, it's taken in a window of space, but I'm going to finish off with this. In terms of the national trends as of February this month, you can see that it's grown nationally about 3.3% in the last 3 months, which is last quarter, but it's grown 9%, 9.9%, so about 10% across the year. Sydney, to my surprise, I must say, is actually grown by 3.2% in the last quarter, and it's grown by nearly 15% in the last year, which is really surprising. But it's starting to plateau. Melbourne, very interesting story, median price of about $1 million now. They've reached that $1 million mark, and they've got a 1.9 increase in the past quarter and a 10.5 increase in the past year. Brisbane, surprisingly, has grown about 1.3% in the last quarter. Continue. So I've got some very optimistic, predictions for Brisbane, but really good opportunities in Brisbane at the moment. Perth, we don't buy in Perth for a number of reasons. There's 40% of the GDP in Perth, still very much a mining town. It's grown by 0.9%, and it's got 1.6% increase in the past year. I think it's an emerging market yet for us and for our investors. Hobart, interesting, grew really, really, really high, 2.8% in the past quarter and 16.3% in the past year. And Adelaide grew by 0.8% in the last quarter and 7.4% over last year. Overall, obviously the property market is still growing, but it is growing at a much lower rate compared to the previous year. So, really good opportunity, good window to be able to look at some good opportunities and deals to get that across the line. Yeah. So that's a little bit of the Australian property market update. That's a little bit about us and how we help our clients and what makes advisors. I've certainly been helping a couple of Finlay's clients to diversify their portfolio and to look at properties as a vehicle towards creating wealth. Finlay, thank you so much for the opportunity to share my story and to give some updates on the Australian property market. I think you're muted.
Yeah, that was wonderful, Colin. Really appreciate that. That was great insights, and I was pleasantly surprised you could squeeze all that in 20 minutes. And the insights there in terms of the regional growth is fantastic. And also, you've made my phone go off. And just to remind everyone, there's a Q&A section there. You can just pop that in, and we could actually sort of field it towards the end. But one of which was, should we sell all the investments with Finlay and move everything to properties? And what's your answer there?
Well, I prefer diversification. I don't think you should
Sure.
put your assets class in one asset.
Yeah.
Properties invariably will have its own ups and downs. But I love property because we can leverage that. But you know, I take a diversified approach myself personally.
Hugely. That's great. And also having passive income, it allows you to have a bit of a quality of life, isn't it? In that there's less requirement for exertion, and you can do other things that you typically want to do as a person. And I think that's something we're advocating with a lot of our clients, is how to develop passive income with a diversified strategy. And property is obviously a bit of an Australian story, isn't it? You know, having bricks and mortars provides that comfort and peace of mind. And so it's a constant question and evolution with our client relationship. And so I appreciate that, Colin. And stay on for the next one. We've got Claire Coyle and Sam Weiner from Australian Super. Welcome, guys. Really happy you can join us.
Thank you.
And really appreciate you turning up in your otherwise busy weeks. And just to recap, we've got the session recorded for those that are online and offline, and quite a few clients are offline because they're quite concerned about being on Zoom and being on cameras and things like that. I reassure them it's the modern way of doing things, and they don't have to turn on the camera, but nevertheless, they'll still hear your lovely dulcet tones for a recorded version. With your permission, is that okay?
Perfect.
Yep, absolutely. Thank you so much for having us, Finlay. Thank you for the invite.
Pleasure.
As you said, if there are questions, feel free to pop them in the chat. If we don't get to them, I will collate them and send them through to Finlay, who can distribute them out. But I think over to Sam.
Yes, lovely.
Thank you, Claire, and thank you, Finlay. So I got a chance to catch a little bit of Colin's speech right before this, and some of the things that kind of came out of that is that idea of taking charge of your future and really looking at that financial security in retirement, because effectively one of the visions Australian Super has is that all Australians should live well in retirement, and how do we actually uplift the system so we can do that for people. So I'd like to start off by acknowledging the traditional custodians of country in the lands that we meet today and their connection to the land, sea, and community. I'm calling from the lands of the Wurundjeri people of the Kulin Nation, and I pay my respects to their elders past, present, and emerging. And at Australian Super, we find it's very important to provide this acknowledgement, largely due to that super isn't super for everyone, that there are a lot of people that have been left behind in the system, and we do really want to uplift all Australians so that they can be financially secure. So that acknowledgement is pretty important for us. When we look at today, what we can focus on is we can look at an overview of our investment process, highlight some of our asset allocation approaches, and we'll throw in a little bit about the current economy, what we see currently, as well as discussing unlisted assets. So doing a review of that and provide some examples of some of our performance results as well for you. To start, I'll share my screen here. Do I have the ability to share screen, I believe?
You should do.
Let's see.
Just have a look 1 second. I'll just do that for you.
There it is. There, I think I found the right button. There we go. Perfect.
Yep.
Now it's working. And So first, we basically start off there with the acknowledgement from our compliance team. They couldn't be with us today, but they want to make sure that we do say that this is general information and not personal financial advice, and that you should read our PDS and target market determination before you make any decisions. And of course, talk to your advisor. So it's a very important part of the process. When we start off, it's worth looking at the investment process from the top down and really the governance that goes behind it. So when we look at our investment process at Australian Super, you often hear the watchwords long-term investment and total portfolio approach. But it's also important to look at the governance involved there of how the board interacts with the investment committee, the CIO of our investment team, as well as the asset class and down to the portfolio manager level. So at Australian Super, we do actively invest across asset allocation as well as security selection. We believe that is a better way to invest over the long run of really enhancing value for members. And in this process, we look at the board sets the risk or the broad objectives of the portfolio of what we should do. So we think of the investment options objective to outperform, that is set by the board. The next level down, when you look at the investment committee, they basically oversee the asset allocation, the risk budgets, how much we should spend, the cost budgets in that process. Delegating down to the next level is the CIO, or Mark Delaney, basically directs how much assets should be in different areas and which areas of the asset class team should have that. And then the head of each asset class team, the asset class teams being our equity team, our fixed interest team, as well as our unlisted assets or mid-risk team, they are the ones that actually invest the money. And then down to the portfolio manager that basically does the security selection, either picks an external investment manager or directly manages on our members' behalf. So it's effectively what we want to make sure is we get the decisions at the right level, that people have the power to make those ways to enhance the portfolio. So by putting that security selection decision down on the portfolio manager, and lets the head of asset class team more direct traffic more broadly in terms of total exposures of the portfolio. So that's a key part of the process. On top of all of this is also, as part of that investment team, is what we call our total portfolio management team, which really sets that asset allocation and determines how we should direct the total portfolio assets. So you may see in the industry things like diversified options, or we call them here pre-mixed options, which are diversified pools of assets that invest in lots of asset classes like equities and cash and so on. Our total portfolio management team essentially sets the strategic asset allocation for those, and they analyze the market conditions to be able to do that. So on the next page, I'll show an example of a strategic asset allocation. And this is for our balanced option, where about 90% of our members invest. And what they actually do is they look at the valuations, the current valuations. They look at what is the economic outlook in different areas. They look at policy, so basically monetary policy. What are the central banks doing? Fiscal policy, how are governments spending money? And then looking at how do we actually construct a portfolio that has the attributes to meet the portfolio objectives, and it's essentially getting the best return possible for a given level of risk. So we allocate among these asset classes, which is your traditional asset classes like Australian shares, international shares, fixed interest and cash, which you're very familiar with. We also have the opportunity to invest in private equity, unlisted infrastructure, unlisted property, as well as credit, which is private credit in the portfolio. By pulling all these together, that's where we're really looking to optimize how we invest. The one benefit of the structure is things like that unlisted infrastructure, the unlisted property, they are relatively illiquid assets, so they can't be easily bought or sold. But the benefit of Super is that long-term investment, where majority of people don't need the money for 20 or 30 years. Even if you're in retirement today, you might be looking to earn an income off that money for even several decades in retirement. So we have basically liquidity limits, or basically listed limits in the portfolio of about 25 to 30%. But that really enables you to invest in those assets that have a higher long-term performance without the concern of that day-to-day liquidity. So a key advantage you'll see in a lot of super funds out there is this ability to invest in unlisted assets. And effectively, for the illiquidity risk that you take, you tend to get a higher performance out of private equity compared to listed equity, and also a higher performance out of unlisted infrastructure and unlisted property. Also remind you as we go, please throw questions in the chat. It's always good to. This is a presentation for you, so if there's any questions as we go along the journey, I'd be definitely happy to take them from you.
Sam, we have a question offline.
Sure. Perfect.
One of which is, can you explain a little bit more about infrastructure? We've heard a lot about it through the documents in Australian Super and other context or media outlets, so to speak.
Perfect. Yeah, we'll cover off of that in about 2 slides. We'll take a look at that in more detail. Excellent. So we've started with the strategic asset allocation, which is really our long-term view. It's also worth noting that we do adjust the portfolio based on our current outlook. So if you think of where we're at now, and Colin kind of led into this a little bit about, we are in an uncertain economy now. There are these aspects of slowdown. These high interest rates are possibly leading into a slowdown in global GDP growth, and some countries being impacted more than others. We see some big headwinds in the U.S. and Europe, where it is looking like it's slowing down almost to the point of recession. In Australia, we expect things to slow down, but we may possibly avoid recession here. And there's kind of two levels of recession. You can have a actual negative GDP growth, but then if you think of the bigger recessions that we've seen historically, is you have a large loss of jobs or a higher unemployment rate. So hopefully in this next year, we can avoid some of the loss of jobs aspect of it, but we could still see a slower global growth. What that leads us to in our asset allocation is what you see this change here from last year to this year. So if you look at our asset allocation and our balanced option a year ago, the orange bar and the blue bar being this last 31 December, we've done what we call defensively position a portfolio or taken growth off the table, where we've lowered our allocation to Australian shares and international shares and increased the allocation of fixed interest assets, largely because we do believe that the economy is slowing down and there will be some challenges to the growth assets in the next few months. So this shows an example of, we have a strategic asset allocation, but we do tilt the portfolio based on our economic outlook. So this is a key way we look at the portfolio. Starting to lead into that infrastructure question is we do see private equity and infrastructure as examples of assets that we expect to have a higher performance over time. And that's why you see the upweight in those asset classes. Now you're probably very familiar with things like equities and fixed interest. We often, you talk a lot about those in many different forms. They tend to be the things you see on the news as much, but those aspects in the middle, those unlisted assets, generally you don't hear as much about. And that's really what we call them, our mid-risk assets. And really fundamentally what that actually is that balance between growth assets being, say, listed shares and defensive assets being fixed interest. So they tend to have growth characteristics where they do have long-term performance, but they also tend to be more stable than listed markets. They're not valued quite as often, as well as they tend to uphold their value over time. So the one that's why we call them mid-risk, because they sit in the middle of the spectrum. So some examples that we have in our portfolio, if you think of infrastructure, is those essential services. It could be things like toll roads, ports, airports, digital infrastructure. Endara is probably better be known as Australian Tower Networks. That's an example of some digital infrastructure, which is kind of that wave of the future. If you think of how much we use our phones, as well as you think of our video today. unlisted property, that's where we tend to see large scale property investments, either in residential, retail, or office properties. And some of the key aspects we see there are it's almost leveraging into more development type properties as we expand the portfolio. So how can we not just own the properties, but help to develop those sites? And some of the more recent ones that we've looked at there is things like Canada Water in London, as well as the Moorebank Logistics Park, as well as Mascot out of our Sydney office, of our Sydney area. So those are areas where we really are looking to amp up and increase the assets in those portfolios. Recently, I heard basically our head of our mid-risk area, Jason Peasley, he had this aspect of kind of taking you on a journey that you think you're flying into Sydney Airport, you're basically flying over Port Botany, which is New South Wales' largest container handling facility. And then you're flying into Sydney Airport, which both of these assets are owned in the Australian Super portfolio. As you're leaving Sydney Airport, you're traveling on the M5 by taxi, which is basically owned in the portfolio through WestConnex. There's a new development called Mascot, which is basically an office development that's bringing together how people live and work. You'll see trains go by throughout a Moorebank facility, which is also in the portfolio, and that the Moorebank is really that intermodal hub, which is basically bringing together the interstate railroad with Port Botany. And all these assets are effectively owned in our portfolio. And really what that brings together is that interconnectivity of different assets that we hold, as well as how we can invest in different ways in the portfolio. So it's pretty amazing that we can help grow Australians' economy, as well as achieve returns for members by providing the access to these assets. And largely it's you can basically you're investing in multi-billion-dollar deals when accessing these assets, which aren't always possible for us as individuals. So it's a pretty amazing process. Questions on that so far?
Another question for you, Sam.
Sure.
In terms of the underlying investments like infrastructure and property, how important are those, or how often do you review the investments? The question is, and what do you determine as just reading the text here, what do you determine as a successful investment?
Interesting. So, so it's in terms of reviewing, it's more of an ongoing review aspect. So you think of the unlisted assets, we are buying them for the long run, but we want to make sure that they're continuing to meet the needs of the portfolio. Probably to bring back a few examples. So you think of the property portfolio, it's had some challenges over the recent years. So that is one area we admit that it's underperformed for us, where some of the assets like Ala Moana and Honolulu, some of the office properties faced a lot of headwinds. Even before COVID, they faced some headwinds of basically the competition from e-commerce. And by holding those in the portfolio, we do look at those now to see, is that the best investment going forward, or should the whole portfolio be reevaluated? So assets are reevaluated on an ongoing basis. Some of the longer term assets, of course, can be harder to liquidate from time to time.
Yep. And another one is, do you have people overseas experts at overseas or is it purely desk side assessment of assets?
That's a good question. So that's the one aspect of with Australian Super is we have expanded into overseas markets. So we have a London office as well as a New York office. And we also have some economists in our Beijing office as well. And a large part of that was really what you see on the screen here, to really get into infrastructure, property, private credit, as well as even private equity. You want to have local expertise or boots on the ground in those areas. So the London office was opened probably closer to about 5 years ago. New York was opened just this last year. And those offices are primarily filled with people that are looking at these unlisted assets to help develop out those portfolios. So it's actually a key part of Australian Super and a key part of our way of looking at global assets. And we kind of look at it two ways, that about 50% of our assets are invested in Australia assets, whereas about 50% are global. And that's primarily for diversification, as well as really weighing up the benefits of investing in Australia, as well as getting that broad diversification.
Well, thank you for that. And that's great.
The second part of that, sometimes the question about infrastructure and unlisted assets is the review, as well as how do you value them. So we do find the valuation process for unlisted assets is something it's number one, it's very high, it can highly regulated, or gives regulators definitely look at it. If you followed the media in this last year, especially, it has come up in the media quite a bit of how do the industry funds value their assets. And we look at three key things. There is, we want to make sure that there's fair value in the crediting rate process, so that we have a fair value of assets in the portfolio. We want to make sure that they're valued frequently enough, so the frequency of valuations is important, as well as we have independent valuers that value the assets. So this part here is basically the asset class teams being our investment managers, the independent valuer, as well as our internal valuation team, kind of all work together to make sure that we have the right value in the portfolio. So the independent valuer will come to us with a range, and typically we will take the midpoint of that range for that asset. So that's most of the time that's what happens. But what we do find is, if our valuation team reviews that, we do respectively challenge the valuations if we think that's too far off of what we know about that asset. So it's majority of the time we take what the independent valuer provides, but we do have a review process to make sure that we do provide fair value for our members. But it's big for frequency. Most of the larger assets in the portfolio, a lot of those assets that we saw listed on the previous page, most of those are valued at least quarterly. And if there is any change in the market, similar to like COVID-19 was the last time, is we will do an inter-period valuation like we did in March 2020 if we find that something changes, or if something within an asset changes, we'll make sure we update that valuation.
Yeah. And back to, we got one question here about your balanced fund. That's a default option by definition. And it seems to be one of the better performing options in the marketplace. The question is, does it have to do with asset allocation, or is it just a fluke?
Very interesting. They must have saw my presentation, because they actually helped me segue into the next slide. So our balanced option, that is about 90% of our members invest in that. That often is considered our flagship option, or the kind of the starting point for a lot of our other portfolios. But this basically shows the performance of our balanced option compared to the median manager out of the super rating survey. So the orange bar being the performance of our option, and the blue bar being the median manager. This does show that long-term outperformance, that we have been a top ranking fund over the long term. We're ranking number 2 over 7, 10, and 20 years at this stage. And it's a key part of our process that our goal for the option is to beat the median manager, and internally we even have that margin that we want to actually outperform that median manager by a particular margin. And the key benefit for anybody invested in it is that you think over 20 years, that's 61 basis points, that outperformance over the average fund. If you invested $100,000, you would actually have an extra $50,000 in your pocket after those 20 years. So so that outperformance, any outperformance you can get when you start to compound that over time, it's definitely important for your super.
Yeah. Significantly there is that the odd excuses thrown about by fund managers that tend to underperform is that we've gotten too big. But Australian Super has still, I think from last count, around 200 odd billion dollars under management. Yep. So size by definition is still not an excuse for a better word, of lack of skill or execution. So definitely. Australian Super is proving that to be a bit of an excuse by definition.
That's what we saw. This goes back probably 5 years for us, that we actually did look at those global pension houses, and effectively we're we're not the largest when you look at the Japanese pension fund, the Canadian pension fund, SBBM, and so on. So one thing we did is actually look at them and what were their best practices. And some of the key things we did find is that investment in private markets, so invested in unlisted assets, was a key differentiator for them, as well as how they looked at the overall portfolio, having that total portfolio management and bringing it together. So we took the lessons learned of those other larger funds that are out there and implemented them into our process to get those best practices.
Yeah, it's terrific.
It is worth noting that if you do, many people may be looking at these shorter term numbers, that over this last year, we have had some challenges in the portfolio that I think over 1 year, we're basically just matching the median manager. And what we have found is, even when we look back to even the performance of the portfolio, even during the GFC, is during almost negative market movements, we tend to probably lower our rankings a bit compared to competitors. We tend to have more of a growth bias of kind of being probably a little bit more growthy than the average manager. So during times of downturns, what we saw about a year ago, that's where we lost a little bit there. We also think we're a little bit more defensively positioned than the average manager currently. So the one aspect is the last 3 months, we saw a rebound in Australian international shares. So any fund that has a higher weighting to those in the last 3 months, especially, that's one aspect that's where we've kind of lowered in the rankings in recent times. But it's definitely interesting aspect when you look at that economy of, we see relatively high valuations in a lot of the listed assets, as well as this idea of high interest rates leading to a slowdown in the economy. When you see those two headwinds, that kind of directs that we do still feel that there might be some pullback in listed shares in the future.
It's very interesting. I think that 1 year is pretty much across the board, isn't it? I could show you charts of a couple of global funds that double or triple the negative returns. So it's about softening the downside as well, isn't it? Having a bit of a balanced approach, pardon the pun, you know.
I always find it interesting. My investment career is relatively short, a little over 20 years. And I look back and you think of the 1990s in the US, that, you know, the irrational exuberance speech was done in 1996. And that was 4 years before the market actually sold off. So sometimes you can see these headwinds to the markets, that people can be right, but they can be right almost, and sometimes too soon.
Yeah, absolutely. Absolutely. And just another question that's come through, not just for Australian Super, but across the board for industry funds. I guess from a compliance and heightened standards perspective, you guys have the same regulatory requirements as any other super funds in the Australian marketplace? That's the question we've got here. Two of them, so I've tried to sum them up for you.
So effectively, it's through the CIS Act, as well as we're regulated by APRA and ASIC, that it's really, I think that's the interesting part about the super industry, is that there's really not room to do anything untoward or have any kind of malfeasance, because of those regulations. That we live in a very highly regulated environment, and effectively reputation is key. That you really want to, number one, work with regulators on making sure that you meet the requirements, as well as making sure you're acting in the best interest of your clients. So it is a very heavily regulated field, and I find it pretty amazing coming into it. I worked in the managed fund industry for many years, and coming into super, it's almost an additional layer of working with APRA to make sure you have the right information in place.
Yeah, absolutely. And I think earlier we had a little bit about compliance and our requirements, and the induction program I had with Claire was, you have to make sure you're aware of when you're completing applications and things like that. They're quite specific, and it's kudos to you guys always, you know, taking that extra step and going above and beyond what's required. So that creates a bit of a comfort around clients' monies and investments. So yeah, that's a great session, Sam. A really good coverage of what you guys do, and without doubt, you and Claire are very busy, so appreciate your time. We've got a few questions here, but generally I've tried to sum them up in in a broader sense, and you've answered most of the questions. You may choose to hang around. We've got the next guys talking about from MA Financial Group. I've got Frank Daniele, and he'll drill into a little bit more detail about private credits and the private markets that you talked about. That gets that extra bit of return and some of the misconceptions around it, their insights, and hopefully I'll be better educated as a result too, because it's a complex area. So I'll just invite them along. Thanks, Sam.
Thank you very much. Appreciate it.
There, you and Claire, and I've got a bunch of questions coming through for you, Sam, but I'll just hold tight on those.
No, you definitely send them through to Claire, and we'll make sure they're covered.
Yep, absolutely.
Yeah,
yes, of course.
Do you have direct shares? There's an investor portal that you have some of the features. So we'll share that. I'll share that with Claire, and we can take that offline and get back to the relevant person.
Perfect.
So we'll try to get the other group on.
How's that, Finlay? I'm just getting video.
Hello.
There we go. Good
Hello.
afternoon.
Yeah, you're between us and getting the kids or whatever the afternoon for everyone else. So
There's a lot
welcome.
of videos, correct.
Hey guys, so it's Frank Daniele and lovely Aidan McCloskey. Is that correct?
That is correct. Well
Everyone's
pronounced.
close
Finlay.
to the camera, but you seem to be a little bit further away. But
Oh, is it that me? There we go. Perfect.
excellent.
How's that,
Are we
Finlay?
better or?
That looks great. That looks great. Two handsome gentlemen.
We actually prefer it when it's at a distance, but there we go. So.
We did that on purpose.
No, that's fine. And we just wanted to thank you for joining us. And so far it's been as interactive as it gets. We've had the two individuals that helped us set up the license in our own right. Charles Blake being busy, he had to dart off. Evelyn Albrecht, two consultants in their own right. We've had Colin Lee sharing his insights about properties and being I guess, inspired realty, looking at opportunities and insights in terms of growing areas in the property market. And just before you was Sam Weiner and Claire Coyle from Australian Super, sharing some of the insights of how they look at their asset allocation and particularly their balanced option, with some focus on infrastructure funds and unlisted funds, and the reason for it performing really well compared to other peers. But welcoming you guys, and I guess introducing yourself as the MA Group, which is a listed company. So Frank and Aidan, Frank is the managing director of MA Group, and Aidan is the lovely business development manager who I became to know before being involved with MA. So you have basically a platform and lending business, and being a listed company, you have an asset management, lending and corporate advisory side to the business. Frank, you have extensive experience overlooking a team that manage private credit markets and investments. And I guess sometimes when you talk about private credits and private markets, we get a little bit confused ourselves as advisors. If you wouldn't mind explaining what that is and how you actually set about to lending money to relevant participants to extract what I guess Sam from Australian Super alluded to, is that a little bit more return per year because there's an opportunity and growth for clients' portfolios in that segment. Over to you. Welcome. Thank you.
Great, thank you.
Thanks, Finlay. Maybe before I hand over to you, Frank, you kind of stole the words out of my mouth. An awesome introduction. I guess maybe very quickly, we are an ASX-listed diversified financial services firm headquartered here in Sydney. I guess, but with offices now in China, Hong Kong, the US, and the United Kingdom, to name a few. In terms of the history, maybe very briefly, because it kind of stems in well with that private markets, private lending piece and question you just asked, Finlay. We started or born out of a 50-50 joint venture with Moles and Company back in 2008. So again, the DNA of the firm is really corporate advisory, and in particular, real estate and restructuring, which is something that we still kind of do and do very well even today, albeit in asset management. But I guess digging into that private markets and what we are as an asset management group, we are an alternatives platform. Today, we manage 7.8 billion across private equity, real estate, private credit, which Frank's going to sort of, do a deep dive on today, and then a range of other sort of alternative property / traditional asset classes we manage through the SRB program, which we pioneered. That's a pretty good start, considering Finlay's already given us a nice intro. Frank, did you want to start maybe on what is private lending, what is private markets, and we can go from there?
Yeah, sounds good. Thank you, Aidan. Great to speak. Finlay and team. Look, we actually think about private credit as something very straightforward, which is it is the provision of a loan to a company or against an asset. So a loan secured against an asset or a series of assets. It's actually as simple as that. And in a way, it's very similar to traditional fixed income, where you're thinking about bonds, but we think with some advantages and some differences that you need to be aware of. So it's actually really straightforward. We just think about it as, if you're doing private credit, what you're doing is you're going out there and either investing in or making, creating debt obligations of counterparties, borrowers out there in the market. The key difference with private credit compared to something like bonds, for example, is that these loans are originated directly. You can't just go and buy them in the public markets. You can't buy them over the counter, and they are done what we call bilaterally, meaning going directly to a counterparty. That has some key differences in that it means that the loans themselves, the credit itself, has less liquidity, if you will, because you can't just buy one loan today, go and sell it tomorrow to a counterparty, and you have to be aware of that. The difference in liquidity of the markets versus something like bonds is no different than in private equity. If you own a whole company versus owning a stock traded on a stock exchange, you're going to have some different liquidity in terms of how you can enter and exit that particular asset class. But the other element in private credit that we think is really core to the outsized returns that asset class has generated compared to other types of credit is that when you are creating that loan directly, you are involved in what we call proprietary deal flow. So you're finding counterparties, borrowers or assets that you really want to lend against. You're finding a way to do it. You're negotiating the terms in a bespoke way, tailoring your underwriting standards to whatever's happening in the world at that time or the counterparty that you're facing. And that means we think that you can extract an outsized return relative to the risk you're taking, because you can genuinely have an element of edge or an element of differentiation, strategic advantage, call it whatever you want, in sourcing that asset, rather than just bidding into a screen where it's actually very difficult to get any element of edge because there's just a lot of people doing effectively the same thing and bidding for a finite universe of assets. We think some of the other big elements are security as well. So, private credit benefits from being in a secured position, either over assets or against a counterparty, borrower, or whatever, which has a lot of advantages compared to bonds, which are typically unsecured obligations. And the final element is the sort of diversification element of it, which is that private credit gives you a different type of correlation to the rest of your portfolio. Particularly, I think, if you're in Australia, where our traditional fixed income markets like bonds are basically, there's like 4 banks plus Macquarie, 3 insurance companies, 2 regional banks. That's the most of the issuance of bonds in the market. So if you buy a bond in Australia, you're very concentrated to the financial sector. Whereas If you're in private credit, you have a much more diversified exposure on a macro basis. And we think that has benefits around how correlated your portfolio can be.
You're just on mute, Finlay.
Muted.
It's
Now that's
4:40. It's 4:40 in the afternoon.
Yeah, not quite, but about 18, 20 minutes away. But now that's a great explanation. And one of the questions that's coming offline, there's a few people are on the phone. So one of which is with private credit, is that lending to borrowers like buy now, pay later clients, investing directly in companies? Is that the summary there from that question that I've got here?
Look, it's a wide universe of potential options in private credit. So it could include all the things you identified. That doesn't mean that they're all the areas within private credit that we like. So if I think about a few of the examples you threw out there, and I guess what we do like and don't like, buy now, pay later is something that we have been incredibly skeptical of and have not included, at least in any of our portfolios or investments around the private credit space. What we have really liked is a space we call asset-backed lending, which basically means funding very diversified loan portfolios. But we don't want to do it where it's something exposed to the unsecured consumer. Instead, we want to be exposed to either a secured asset, so like imagine it's like a property asset, a fleet of vehicles for a corporate, certain types of asset finance, for example, or some specialty assets, which we can talk about. We also like things like senior secured real estate credit. So that's, being in a senior secured position, say up to 50 to 65%, for example, LTV, loan to value, against on a first mortgage basis against high quality real estate or physical realizable assets. So that's the kind of area of private credit that we really like. We also have some strategies where we do participate in things like corporate exposed debt, again on a senior basis, but we have avoided, and we think it's important to avoid in the private credit world, some of those new and unproven asset classes, of which buy now, pay later might be an example. The reason we think that's so important is that we're kind of in a world at the moment where we are going through the most aggressive, globally coordinated interest rate increase cycle that is on record. So you've never seen a velocity of increase in interest rates like this globally, and it's the same here in the RBA that just doesn't on the data set. So if you're thinking about what happens in that environment, what happens to borrowers, the key thing is going to be, one, being exposed to borrowers who can service their loans and where the loan itself is really important to them for some reason. And then second, that if they, for some reason, that borrower can't service the loan, that there's a really good way to protect your downside, for example, through selling security assets collateral. So if I think about something like an unsecured consumer loan, imagine a household that's got $100 of income and all of a sudden their mortgage repayments have gone up. What they're not going to do is immediately default on their house or their car. They might need the car to go to work or to take the kids to school or whatnot. But they might look at their credit card and say, maybe I need to push that away. Maybe the buy now, maybe I actually don't need to maybe I'm okay to default on that buy now, pay later obligation, but they're going to really fight to, for example, keep the house and the car. And so, I think that's important. And particularly then if you get a really good set of diversification across lots and lots of borrowers, then, you can protect your downside there in a more diversified and aggregate sense.
Yeah, that makes a lot of sense. And just trying to get a few Q&As here, questions, just putting it together. Of course, the impact of rising interest rates, what does that mean typically for a private credit specialist like yourselves and others? Does it impact your investments? And And then how does investors get access to your investments?
Yeah. The good thing about private credit is that it tends to be floating rate, which means that if rates go up, unlike with traditional fixed income, which can often, not always, but often be, fixed rate exposure, private credit's floating rate oriented. So as rates rise, you do get an income pickup that can start to be quite material. So that's great. I think it's important not to stop your analysis there, because if interest rates are rising, meaning the cost of debt is rising, you need to make sure that that your borrowers or the assets you financed against can actually support that higher level of ongoing interest payment. So it's really important not just to have a good security asset, but also to have really good cash flow serviceability of the counterparty. And we think a lot about that. So with that caveat, I'd say that the historical performance of private credit, particularly direct private credit, meaning where you've gone and made loans on a proprietary basis directly to counterparties out in the market, has historically performed, very, very well, including through rising rate environments. The best data on this is global data. There's an index called the Cliffwater Index for direct private credit. Over a very long period of time, that has outperformed things like whether it's leveraged loans, corporate bonds, or high yield bonds by a factor of between, sort of 1.6 times and 2.3 times. So the return has been there, and the volatility in the asset class has been much less. We are seeing that absolutely in our portfolios at the moment. The other thing that rising rates does for private credit is that, particularly for funds or strategies that have been performing resiliently through the last couple of years and have dry powder, is that the opportunity for new deployment is the best in a generation at the moment. The sort of spreads that we can deploy at the moment, the returns we're able to offer our investors in high quality credit is outstanding. So what we're really getting is an excess return per unit of the risk that we're taking. We're not taking no risk, we're out there investing money, but the returns that we're getting relative to that risk we're taking, which we think is low, is really fantastic. And so it's sort of a really exciting time in the asset class at the moment. The other thing that's important with private credit, and we spend a lot of time on, is trying to make sure that you build a portfolio of asset classes within private credit that have different correlations, and in particular that you have a large part of your portfolio that doesn't carry broad macro risk. We've done this by investing a lot in asset classes that are either specialty and or asset backed. So to give you just a couple of what I think are really good examples of this, there's something that we have funded. It's called insurance premium funding. So basically, if you're a small business and you go and pay your insurance. So imagine you're you're an industrial business and you need to have public liability insurance, workers' comp insurance, et cetera, for your business, mid-sized corporate. You can go in maybe you're small listed company and you've got, or any listed company, you've got directors and officers insurance, et cetera, right? You go out, you pay that insurance, you've got two options. You can either pay in one lump sum or pay by the month. If you pay by the month, what's actually happening is that someone is financing the insurance companies the premium, and then they're collecting every month from the people paying their insurance premiums. But the unique thing about this type of financing is that if you are the funder of this, or you're funding into this, what's actually happening is, for various reasons of insurance law, if the counterparty, say the business, doesn't pay their monthly installment on the insurance, you, the funder, have the right to cancel the policy, and you obtain the rest of the premium that was due to be paid for the pro rata part of the year. So what it basically means is you are obtaining the credit risk of major insurers. I think you're getting the credit risk of Allianz and Berkshire Hathaway, whatever the very large insurers out there are in the relevant book, QBE and so on. But you're earning a small business rate of return. So you're getting a return up here, but you're taking risk that's like effectively investment grade and your capital's got that downside protection, plus every single one of these individual policies that you're doing the pay by the month thing with is actually very small. So you've got massive levels of what we call over collateralization, lots and lots of diversity in your portfolio. So you'd sort of need like a mass systemic system-wide collapse and all the insurers to be falling over in order for you to be losing capital. That sort of financing has nothing to do with, it's totally uncorrelated to the performance of mortgages, for example, or the performance of unsecured consumers, or if you're taking, bond corporate type exposure, it has nothing to do with what's happening in the world of corporate earnings. It's just a completely uncorrelated asset class, but the returns are really good, the security is very strong, and the downside protection is high. So, I think in any portfolio, you want to balance what you've got around exposure to different types of asset classes. And the way to do that is doing it through a fund investment.
That's
Yeah.
Mhm.
Sorry, I was just going to say to your second point there, Finlay, on sort of accessing some of these products, which often are, multi-credit segments and credit products within a single fund. I guess going back to an earlier question you had, Finlay, around the types of borrowers and the types of loans that we do. We took a different approach, particularly with our product set, that is our credit funds, the offering, in that rather than create, big, diversified credit funds, typically one or two, we split our credit segments up into a real estate sleeve, structured finance, corporate style sleeve, a diversified sleeve, but again, with a fair bit of overlap, albeit correlation benefits like Frank speaks to. And we've broken them up into sort of 4 different pockets of credit. All of our credit funds are, are open-end. That is evergreen fund structures where we raise capital on a monthly basis, as at today, distribute monthly as well, and provide monthly liquidity, again, for all 4 funds, irrespective whether they're retail, wholesale, in real estate, or diversified. In terms of accessing these credit funds, look, the most dominant way that we see, 92% of all the flows we see into our credit funds are through platforms. So that's been a big part of probably our business. That is the distribution side the last, 12 to 24 months, which is getting these credit funds out there and on, basically every platform there is out there in the market, whether it be bank alliance or independent. And most importantly, getting the research required and the asset consultant buy-in to garner that kind of demand on platforms. So yeah, there's a variety of ways, but I guess overall they're open ends. You can go into them, anytime throughout the month. We sort of allot units once a month. That is monthly applications, a very easy online process.
That's fantastic. Thanks for explaining that, Aidan. And definitely Frank also with that insight on being able to reduce the risk levels in total sense. And looking at a bunch of questions coming through, there's some people that know more about private credits than I do. So one of which is, what if the next global financial crisis hits? How does that hit? How does that impact your distributions and your earnings within? I mean, obviously you've explained that sort of in that the way you reduce the risk levels in terms of the exposures you take with your counterparties. Will it impact your cash flow and therefore the overall performance of your delivery or your fund? I think that's what the intent of that question is.
Yeah, I think there's probably 2 ways to, or 2 parts to the answer to that, Finlay. One is in relation to the investments that we're making in the funds. And then for some of our funds, we can talk about the fund structure as well, which has, again, for some of our vehicles, it provides additional protection for investors for that very reason. So just for the first point, what if the next financial crisis hits? This is something we think a lot about. We got into credit investing because a number of the long-time executives here and founders of the firm MA had backgrounds in something called special situations and restructuring, and that is advising on scenarios of debt gone bad. If you think about any big restructure that's happened in Australia, whether it was Centro, Billabong, bought Longyear, the Murray Goulburn situation when it was in strife, Channel 10, Channel 9, MA was involved. So sort of like a 50 to 70% share back in advice. So we have seen the dark side of credit, and we try to apply that thinking to how we make investments, and really understanding how things go wrong and what to avoid. So we think a lot about that question as well. The way we try and protect against it is to make sure that if you think about sort of like a value pie, right? Like here's the valuation, whether it's enterprise value of a company or the value of an asset, we want to make sure that we're down here. We're in a position where even if the value of this asset changes, it's not impacting the credit that we're exposed to. It's kind of someone else's risk. It's equity's risk, if you will. And so in pretty much every type of credit we do, we have significant, meaningful equity buffers from someone else who wants to take that type of exposure and that risk. And we spend a lot of time on something we call what you have to believe analysis, meaning there's always a scenario in any investment where you lose. Like it's just impossible not to have a scenario. It might be very, very unlikely, but there's a scenario, and you need to know what that scenario is.
Yeah.
A lot of people do things in credit, like they'll say, oh, but if losses in the world went to X, if unemployment went from 3.7 to 6, we're okay. But that's just not enough analysis. Like, what if unemployment went to 12? Like, there's got to be a scenario where you're going to lose money. You need to know what that is, know the leading indicators of that thing, so that you can make sure that you've got the rights to exit, to get in, work things out early enough to make sure that you protect your downside when that happens. And that's how we try and do it at the investment level, and make sure we've got that right level of equity buffer protecting us, so we're taking that volatility out of the investments. So that we do that a lot on the investment side. In some, but not all of our funds, there are investors who are, particularly risk averse out there and looking for a very resilient type of product. Some of our products, one of them in particular, is actually enhanced beyond that. It is underpinned by a 10% co-investment by ourselves, but this is a bit unique in that it's not just us investing alongside investors. We'll actually invest junior to them. So in this particular fund, what we do, for example, is to we put first loss capital of 10% into the fund. So you invest $100, we'll put $10 of our own money into it. And if we ever lose money, we lose first. And for you to lose $1, we've got to lose all of our money. That fund today is about $700 million. We've got 60, 70 million of our own money at risk. And so for an investor in that strategy, for example, to even lose $1, we've got to go and lose 70 million of our own money. So there are some strategies as well where we've said, as an institution, we want to provide people with the menu of options, as Aidan articulated, for the type of exposure that they're seeking. And one of the options does include for people looking for that really consistent structure, where we are basically abstracting away the volatility for those investors. And in that strategy, we basically pay investors cash plus 4%, so 7.35% today, but variable structure. And that fund's been operating for 4+ years. It's never not paid cash plus 4 in a month, because we've designed this structure to take out that volatility. For our other funds, where the returns are higher than that, for example, to take our real estate credit funds, it's cash plus 5 and change, or 7 and change. Those ones with real estate credit, there isn't the buffer, but we're building within the underlying assets the right kind of resilience in being able to provide investors their return on a consistent basis.
Sure, that's well explained. Thank you. That really explains a lot of the ins and outs. And from a I guess anyone that's left here, Mitch Miller and Colin Lee, if you have any questions, jump in. We've got quite a few people on the phone call. From a planning puristic perspective, do you classify your investments as a defensive asset, or more of a growth asset, but that's kind of lowly correlated with your mainstream assets? Would it be fair to say you're defensive by definition, or?
Definitely, Finlay, and even using, and that's not just us, using that terminology. If we were to look at, Lonsec recommended, Bond Advisor, SQM, some of the strong endorsements we have within research, And across really the whole asset consultancy space, you'd put us in what we call probably the alternative income bucket is probably what we fall into the most. So we're not saying it's traditional fixed interest, but it's certainly not growth or alternatives in the sense of, like to what you're saying, private equity, private market exposures with sort of a more of an alpha or capital appreciation element to the investment. So more and more we're seeing these types of investments, that is private credit funds, particularly something like the Priority Income Fund, which Frank described, which had that 10% co-investment piece placed in that defensive fixed interest part of the portfolio, particularly the last 3-4 years. It's great that we can talk about rates moving around at the moment, and obviously that brings optionality. It brings a lot of dormant traditional fixed interest products, back on the market, hybrids, even term deposits. But I guess where they haven't been the last 4 years, while rates have been at sort of, next to zero, private credit has really filled that void of sort of anything from, 3 to 7%, which was typically dominated by that, defensive fixed interest bucket of the portfolio. Yeah. Will that change? Potentially. There actually are advisors, I dare say, using it, even more like an equity-like return. That it would never be in an equity part of the bucket, but with some credit now delivering double digits off the back of where rates have moved to, it absolutely could fill that spot or that void of what probably equity returns did for you the last sort of decade.
Yeah, no, that's really well answered, because within that cash term deposit environment where clients potentially, most of our clients are in that pre-retirement, post-retirement, where income's really important. They've struggled with cash and term deposit, and it's starting to resurrect itself. But when you look at private credits, it's potentially a diversification in that segment in itself. So that presents a good opportunity. All in all, it's 5 o'clock. Dearly appreciate you guys being here. There is a few questions coming through. Maybe I'll just direct them to you, Aidan, offline, and see if we can get a few answers. But
please do.
I do say thank you for coming along, and I know you're busy, guys, and have a great afternoon. And the recordings will be made available if that's okay with you guys, and
of course
the rest of the crew. So we'll catch up in the near future, very near future by that, and have a great afternoon.
Thanks, Finlay.
Thanks, Finlay. You too,
guys.
See ya.
Thank you.
Thanks for your time. Thank you.
Bye for now. Bye. And to conclude our Rounded Wealth annual webinar, I'd like to say thank you to all our guest speakers, our attendees, and hope you enjoyed it. Have a great day.